Imagine working hard your entire life, saving diligently, and finally reaching retirement, only to realize that taxes are eating away at your income more than you expected. Sound familiar? You're not alone. I've seen many people come into retirement confident in their planning, but then caught off guard by tax surprises that come from RMDs, Social Security, investment income. Many retirees assume they'll be in a lower tax bracket in retirement, but they don't realize that tax-deferred accounts, Social Security, and investment income all get taxed differently. And when these overlap without a plan, it can lead to unnecessary tax bills and even higher Medicare premiums. The good news? There are strategies that can help you keep more of what you've saved. In this video, I'll walk you through the biggest tax mistakes retirees make and the strategies that can help you work towards avoiding them. Whether you're already retired or just starting to plan, understanding these pitfalls can make a major difference in how much of your retirement income you actually get to keep. Hi, I'm David Millington, certified financial planner and president of Puzzle Wealth Solutions. Over the past 2 decades, I've helped individuals and families build personalized financial strategies to work towards growing and preserving their wealth. If you're new here, I've been recognized by Forbes as one of the best in state wealth advisors in 2021 and 2024, and I'm currently ranked the number 56 advisor in the United States by Advisor Hub. Throughout my career, I've helped clients navigate retirement tax planning with clarity and confidence. So let's dive in. Tax mistake number 1, planning for required minimum distributions, or RMDs. What exactly are RMDs and why do they matter? If you've saved in your 401k or traditional IRA, there comes a time when you're required to start taking withdrawals. The government wants some tax revenue. And this happens whether you need the money or not. Currently, at age 73, the IRS mandates that you begin withdrawing from tax-deferred account. And these are called RMDs, or required mandatory distributions. And they are fully taxable, which means they can significantly increase your tax bill. Here are some common misconceptions about RMDs. Let me ask you, do you think you'll be in a lower tax bracket when you retire or higher? Many expect to be lower, but once you add in RMDs, Social Security, pension income, you might actually land in a higher bracket than you were expecting. Some retirees think that they can just then reinvest their RMDs and avoid that impact, but those withdrawals count towards taxable income, and then when you earn on them later, creates more income. And that can push you into a higher tax bracket and then trigger IRMAA surcharges, which actually raises your Medicare premiums. It can become a vicious cycle of waste. Another misconception, that RMD planning starts at age 73. In reality, you should start years earlier to give you more control. So let's look at a quick example. John has $1 million in an IRA, traditional IRA. When he turns 73, he's required to withdraw about $40,000. He also receives $30,000 from Social Security, $20,000 from a pension. Now his total taxable income is $90,000, which actually bumps him into a higher tax bracket and could increase his Medicare costs through IRMAA. Please note that this is just a hypothetical example, but it's based on some real life scenarios. Your situation will be different. That's why we need to customize this to you. How do you work towards avoiding this? Consider Roth conversions early. Convert part of your IRA to a Roth well before age 73. That will reduce your RMDs. Use qualified charitable distributions, or QCDs. If you're 70 and a half or older, you can donate your RMDs directly to a charity, and that reduces your taxable income. Withdraw strategically before 73. Taking small, purposeful withdrawals early in retirement can help spread your tax liability out over time. Second tax mistake, mismanaging Social Security taxes. Let's clear something up. Are Social Security benefits taxed? The answer is sometimes, so I guess I didn't clear that up. But the IRS uses your combined income, which includes adjusted gross income, non-taxable interest, and half of your Social Security benefits to determine how much, if any, of your benefits will be taxed. Here's how it works. For single filers below $25,000, there's no tax on Social Security. Between 25 and 34, up to 50% may be taxed. And above 34, up to 85% of your Social Security benefits may be taxed. For married couples filing jointly, the limits are below 32,000, no tax. 32 to 44 is 50%, and over 44,000, up to 85% may be taxed. So how to work towards avoid this? Be mindful of which accounts you pull your money from. A small shift in withdrawal strategy could keep your combined income below these key thresholds. Delay claiming your Social Security if possible. This not only increases your benefit, but gives you time to draw down your assets first, and that's your Social Security benefit. Tax mistake number 3, ignoring IRMAA, those Medicare surcharges. Have you ever heard of that? It stands for Income-Related Monthly Adjustment Amount. It's a fancy way of saying higher Medicare premiums for higher income-producing retirees. Let's break that down. A single retiree earning over $103,000 pays an extra $66 a month in Medicare Part B premiums. A married couple over $206,000 pays $132 a month. And those are just the first tiers. There's even higher surcharges at higher limits. On top of that, there can also be added premiums for Part D. So how to work towards avoiding this? Monitor your modified adjusted gross income closely and plan your income withdrawals to stay below those IRMAA threshold. For example, like why take a distribution on December 20th if it can wait until the next year? And that might keep you below an IRMAA threshold. Also, if you see your checking account becoming overfunded, just suspend your IRA withdrawals for a while if you don't need the money. Managing things like that can be helpful. And when possible, and if needed, use Roth withdrawals instead of traditional IRA funds to manage the taxable income. Some final thoughts on retirement tax planning. It's not just about 1 year. It's about creating a long-term strategy that helps you work towards preserving your wealth. If you would like a personalized tax strategy review, I invite you to book a time with my team using the link in the description below. We'll take a comprehensive look at your financial picture, help you understand, and ultimately discuss strategies tailored to your unique goals. Thank you so much for watching, and I look forward to seeing you in the next video.